Right. Wait for this all to get going. Welcome everybody to Midas Investing Live. Happy Friday afternoon, end of the market week. Trying out a little bit of a different opening time than our usual Sunday afternoons. And out some Friday afternoons. We'll see how this goes. Um, Partially just because I think it's maybe a good time end of the week, right after the market closes a little bit. Obviously not right after, wait a little bit, but also uh people getting off of work, seeing kind of how the start of the weekend kind of crowd goes. I've never streamed particularly at this time, so I figured see, hey, maybe it's a little bit more active for people to come and view it live at this point in time rather than on Sunday afternoons. And as I had said before, I also was kind of curious to see if maybe it was more difficulty than it's worth trying to compete with, say, Sunday night football or something like that. Olga, hi. Well, there's one of our regular viewers showing up, at least right now. So also, took a week off. Didn't stream last week, so hope you guys missed me. But definitely was working on lots of stuff. We're gonna be talking about a whole bunch of things, little side projects I've been working on over the course of the last weeks. My school semester is over, so I'm super excited to have like a month and a half off to work on a whole bunch of other stuff every day and not be super busy with other stuff. But one thing in particular, I did put my Skyworks video out a couple days ago. So if you guys haven't checked that out, I would definitely recommend going and checking out that video. Like it, watch it, share it, all of the above. But Skyworks, a company we've covered in our previous live stream format for valuations a few times before, and it's definitely one that we've been a fan of for some time. And as believe I'd commented last time we done live, I'd already had so, but I did start a small position in Skyworks a little bit before I came out with the video. Unfortunately, it pretty much ran up in price pretty quickly after starting that position. So it's a very, very tiny position, and I'm not really looking to add it at the current levels now. I kind of liked it in the mid 90s and was kind of hoping that it was going to go back into the 80s personally, and then it decided to shoot back around along with a lot of other companies in the semiconductor space. So that is what it is. Beyond that, I have been buying a little bit more AAP here and there, as well as some InMode here and there. Also bought PayPal a little bit. I don't think I didn't buy any PayPal this week, but I bought a little bit of PayPal last week. So still kind of nibbling at a few of the companies that I have a little bit under allocated to relative to my desired levels. We are pretty much in the middle of our desired range for our cash levels currently. Finally, for once for a while, having moved some money around through a few different positions. Am over allocated to a couple of positions right here, which is Smith and Wesson. It shows me it's slightly over allocated to, as well as FG. I'm now slightly over allocated to, having tweaked around some of the details in the allocation system. I'm not acting too much on either of these. In particular, I kind of wish I had trimmed a little bit of Smith and Wesson when it was at some of its peak levels, and I was considering so. But then we had a really large drop in the market, and now honestly, Smith and Wesson is so much closer to a deal than anything otherwise, that I'm still probably just going to leave it as it is. The FG, I've been working a lot behind the scenes, trying to kind of figure out further upgrades in terms of what I think the value might be at this point. And people have asked me about this a lot as the stock has constantly raced up over the course of the year. It's reached basically a target level I've set for it, and then it's continued to race up. I set a new target level for it, and then it continues to race up until it beats that target level as well. So people have constantly been asking me a little bit behind the scenes, okay, well, at what point are you going to be looking to trim some FGs? Is that going to happen at some point? And I keep saying, well, I'm super, super hesitant about it. Even now, for example, if we go over to the dashboard here, it shows my fair value currently as being a little under $40 per share for FG, which means it is overvalued. So at what point would I maybe be willing to consider trimming it? And the truth is I have been working behind the scenes trying to kind of like rethink my overall model for FG, the model that I put together, building up its revenues, and try to kind of really make it a little bit more robust, really details, fill out some of the details around it, as well as some of the other opportunities that the company has in some of the other sectors, particularly including pension risk transfers and other institutional sections of their business relative to the actual annuity portion of their business. So I have been doing a lot of that behind the scenes. I have have been working on building basically a new model for them, even though I won't be really sharing a whole lot of the specifics with that about that model probably until they release their next annual report, which is likely to be in February. Maybe so expecting the video maybe in like early March or something like that, which I probably will make another video on FG when that time comes around. But in the meantime, I am working a lot behind the scenes on trying to how to maybe think about some of those other sections of the business and how that works into the opportunity for them. And then along with that, I have also done a whole lot of other tweakings to my spreadsheets and the way a lot of them work together, trying to fix some other issues I have with them. So with that, I do have a different FG valuation that's different than the, as I was saying right here, $40 per share that it lists right here. But I do have a different one that I've been kind of working on right here, which I'll show you, which it gets it at least up to $43 per share, which still shows it to be a little bit overvalued. But even with this particular valuation, I would say includes a significant amount of weighting towards potential negative outcomes for FG under certain circumstances, certain macro environments that theoretically could happen that could really throw the whole thesis into a tailspin. In particular, for example, I have 20% of the probabilities allocated to circumstances where their revenues would actually be lower 10 years from now than they are as of the current trailing 12 months. Which, by the way, one of the changes I've made in my valuation spreadsheets over the last week is making it so that it more easily works with the most recent trailing 12-month figures, which will make it easier for me to update my valuations on a more regular basis. So that's one thing I've been trying to work on behind the scenes there. But along with that, I also include 20% chance of outcomes 10 years from now, independent of the 20% of outcomes I was talking about with the much lower revenues, but 20% of other independent outcomes in which they're literally not even profitable 10 years from now. So even with that sort of circumstances, about 20% chance that their terminal margins are negative 15% 10 years from now, we still get it at basically about fair value today. And that's also, for the record, with a weighted average implied multiple at those terminal years of 6.97. So we're not talking about anything super extreme in terms of relative pricing. In my opinion, at the end of the day, FG is just super cheap comparative to some of the potential future outcomes. It's not super cheap if you're comparing it to lots of the potential risks in the future as well. But the point is that I think that the potential rewards are much more disproportionate relative to those risks. Mr. Beast, Canadian Solar look fabulous. It's definitely super low and cheap. I know that there's been a whole lot of questions about its narrative, and so that's one of the reasons I haven't rushed over to go take a look at it. But it's been kind of on the back of my mind, on the back burner, or something that maybe I should go take a look at a little bit in further detail. And that might work out well to include it with some of the other stuff I'm going to talk about here today, the relative valuations, the pricing, and how using that as a tool for finding other opportunities. I'll maybe re-reference Canadian Solar when we get there. Mr. Beast also says one day he will donate a few millions to me, maybe. Yeah, maybe. that'd be nice. So, anyway, continuing on though, let me close out some of these tabs right here. Yeah, coming over to the second page where I have kind of partial valuations put together. Canadian Solar, yeah, it's one of the top ones here. But like I said, it's like I think some of these assumptions I kind of put in here initially might be way too bullish, and so it's probably not really worth this much. But the point is, even if I downgrade it a lot, that would still leave lots of potential upside. So yeah, Canadian Solar is one that I've been meaning to maybe coming down to take a look at. But there's a few others on this page that I've been ignoring for a long while. I need to come around and take a look at. One of them in particular, Can4 Forestry, is also going to make an appearance in the discussion about the relative valuation stuff. So anyway, actually, let's start to get into some of that. Beyond, like I was saying before, working on just some of the tweakings of how the spreadsheets work in my valuation stuff. I've been working pretty much on all of my different spreadsheets in some ways, not just the DCF template, but my financials pages, as well as then I put together a couple new tools all together in the last couple of weeks. One tool in particular is a relative valuation tool. relative valuation or pricing, if you're a big fan of As About the Motoron's work, which is something I've done a little bit of, like off the cuff. I've kind of used these techniques just a little bit here and there on specific companies and specific circumstances, but it's something I think I'm going to start doing a little bit more regularly on a lot of the companies I look at. In fact, I might use it as more of a preceding tool where I'll do a relative valuation and pricing to get an idea of maybe where I want to look further within the industry. So I basically put together this kind of template tool that I can effectively use for lots of other companies. I haven't applied it to all of my companies yet, but I've put it together against a handful of other companies. So that's kind of what I was going to show you here today. Then there's also like a pricing and momentum tool, as well as a sentiment tool that I put together kind of at the same time, which it kind of allows me to pay attention to a few other details. And so the idea of these tools is that I have my valuations, which are intrinsic valuations based around the cash flows of a business. But what, it'd be nice if you could maybe improve your timing when trying to enter a position, or improve your security in terms of like what else you've got going for you, just by potentially having the current pricing against a group of market comparables also be in your favor. So not only do you have the actual valuation in your favor, but potentially have market pricing in your favor. But there's other things you could have in your favor too, like mood and momentum. So that's some of the other stuff I wanted to kind of build some tools for taking a quick lens into and taking a look at. So I built this other page as well that we'll be taking a look at, which includes a bunch of momentum factors, including like moving averages, relative volume, short interest, as well as RSIs on daily, weekly, and monthly, but also tracking analyst ratings and taking a look of like buys versus sell ratings, the actual analyst targets and how they've changed over time, as well as insider transactions and EPS estimates. So I basically put together these dashboards for taking a quick lens in, so taking a look at each of these companies, and it's just gonna be some tools I'm gonna be trying to use alongside my DCF valuations a little bit more on the regular, rather than just kind of off the cuff. What is the insider transactions look like for this company? It's usually just kind of randomly been looking at companies, looking at comparables, determining that the macro environment suits the things I'm interested in, looking at some of these share statistic details that are a little bit more relevant to me, and then at that point looking to see how the valuation looks and kind of build like a bit of a methodology around that. So coming back over to the relative valuation tool, I wanted to kind of take a look at that one first. Basically, I put together a comparable group based around really just suggestions from a few different websites that I know of that list comparable groups for companies. So I am kind of outsourcing that process to me in some ways, and then I tend to just kind of thin the group out from a couple companies that I think aren't actually all that comparable. So if you think there's a company here that isn't super comparable, or one that you don't like, or one that you think that's missing, I mean, you can mention the ones that you think are missing, but at the end of the day, I'm just going to blame the other websites and say, hey, I'm not the one that chose these companies. I just kind of am relying on a few other websites to list those companies for me. But I am using a few different websites so that I kind of build at least somewhat of a different grouping for that. And that kind of changes things depending on how you look at it. Like, for example, here with Smith & Wesson, we ended up with 7 good companies. I think there were pretty good comparables. I did the same thing with Interfor, and I have 8 companies. I do the same thing for Barrick, and I have 13 companies. I do the same thing for FG, and I end up with what is this, 13 companies as well. So as you can see, it kind of depends on like which company you're looking at, how many good comparables you can go for, which makes a big difference to this, because we're going to be using a lot of statistical tools right here. And so really, if you end up with a small sample size, that kind of weakens the effectiveness of using these statistics. And so like I'm also trying to build a little bit of a larger grouping around my valuation page, like my actual valuation dashboard, where, for example, on the dashboard we actually do have, oh, this is the wrong page. We actually do have how many companies here? 34 companies on the main page. So if I have all these metrics for all of these 34 companies, then that actually starts to build into a more reasonable sample size for doing comparable analysis. So anyway, getting to the point of this though, I'm using a variety of multiples. Specifically, I have 10 different multiple metrics that I'm using right here, as well as I have 10 other fundamental metrics that I'm then comparing to them. And they are different multiples, different metrics, and the idea is we're looking through at each of these multiples, looking to see which ones have the most statistical relation to the metrics, and then narrowing in specifically on which metrics have the most statistical relevance as well. So we're trying to narrow in on 3 specific multiples, and for each of those multiples, we're narrowing on 3 specific fundamental metrics. I have a PE ratio, a forward PE ratio, an EV to EBIT ratio, a forward EV to EBIT ratio, EV to sales ratio, a forward EV to sales ratio, EV to gross margin ratio, price to book ratio, EV to invested capital ratio, as well as I'm using the dividend yield as a separate ratio as well. That's just an inverted multiple, effectively speaking. So 10 different multiples that I'm essentially cross-reference different fundamentals metrics against. And the fundamental metrics that I'm using includes the revenue 2-year forward CAGR expectations from the analysts, as well as gross margins, operating margins, tax rates, return on invested capital, net margins, return on equity, payout ratios, cash as a ratio of market cap, as well as debt as a ratio of market cap. So all 10 of those metrics, we essentially look at the different multiples and we just try to determine which essentially cross groupings end up having the most statistical relevance. And so for each company, each comparable page, we'll end up having different ones that we end up looking at. So for example, with Smith & Wesson here, I ended up finding that the forward price to earnings ratio, the forward EV to sales ratio, and the price to book ratio were the multiples that had the best statistical correlation. And then when I was trying to determine which metrics were going to best correlate with each of those for the forward price to earnings, I found the forward revenue CAGR, the gross margins, and the tax rate to be the most effective at essentially determining a proper forward price to earnings ratio for these companies. But for the forward EV to sales ratio, I found the operating margin, the return on invested capital, and the payout ratio to be the most effective. And then likewise for the price to book ratio, I found operating margins, return on invested capital, and return on equity to be the most effective methods. So as you can see, it's like which metrics we end up using kind of depends on which multiple we end up using, and which multiples we end up using depends on how good those multiples correlate with those metrics with those companies. So it's a little bit different depending on which comparable group we look at, but that's kind of the point. We're just looking to see at the fundamentals and at the pricing metrics, and then looking to see what the statistics tells us about the relationship between the fundamentals and those pricing metrics. And so if I do that, if I take all those together, then I can essentially determine what an appropriate forward price to earnings ratio and forward EV to sales ratio and price to book ratio would be for each of these companies, given the fundamental metrics that each of those companies has. And then I can take an average between those, because that essentially gets me 3 different over or underpriced relationships for each of those companies. And then I can essentially take a weighted average based off of their statistical relationship to determine how over or underpriced each of these companies is overall. And so that's kind of essentially what we've done here. I come over to this little back dashboard page, which I'm going to try to find some better ways of depicting this information at some point in the future. This shows you a little bit of what I mean here. So for this first one here, I have the forward price to earnings, which I have on the left axis here, and then the tax rates. And you can see that the relationship has a downward line, which sort of makes sense if you think about it. It's like as your tax rate goes up, you would expect the forward price to earnings ratio to go down, because you don't want to pay taxes. Taxes are not something that's good. You're going to be rewarded as a company for managing to have a lower tax rate. So there's a negative relationship between that, and you can see how this works out. And it's worth noting that Smith & Wesson appears to be a little bit overpriced relative to tax rates in terms of forward price to earnings ratios. Then and I chose the tax rate for this particular metric because that was the one that had the strongest statistical relationship. Because you might be saying, well, why are we looking at tax rates for price to earnings ratios? Like I said, we're just letting the statistics take us where it takes us. We're not making that strong of a decision about it, as long as the fundamental metrics make sense. If that's the one that has the best relationship, that's the one that has the best relationship. Now for the forward EV to sales ratio, we found the payout ratio to be the strongest relationship. And this one also has a negative relationship. As you can see, the lines going downward, which makes sense, because as your payout ratio goes up, that means you're going to have less earnings being retained for you to grow your earnings over time, which is going to cause your multiple to be shifted downward on lower growth expectations. So we would expect to have a negative relationship for that as well. And you can see how well those two tie together here. In this particular case, Smith & Wesson appears to be about appropriately priced for this particular metric. And then moving on, we also have the price to book ratio scaled against return on invested capital. Now, return on invested capital is a good thing, right? You want higher return on invested capital, so that makes sense that we can see the line moves upward in this particular case. There's a positive relationship between higher return on invested capital and price to book ratios. And so as a result of that, we can see that the line moves upward over time. And Smith & Wesson appears to be about appropriately priced based off of that metric as well. And so you can kind of take an average between all three of those metrics together. And this gives me kind of the over under on all three of those metrics together. And then I have it scaled against the short interest ratio, which is just because that's like one of the things that I thought would be kind of neat and useful to compare it against, but I might change that going forward. But you can see Smith & Wesson appears to be about appropriately priced in terms of relative valuation, comparable analysis. So this is kind of the approach of what we're doing here. We're basically assigning a comparable group, taking a look at all the different operating metrics to figure out which ones have the best statistical relationships, and then seeing what the metrics should, what the multiples should be based off of the operating metrics based on the comparable group they're in, and then taking an average between all of that. Mr. Beast is in there commenting a few things. He made the comment, SPB still cheap. Guys, I'm holding 2,000 InMode stocks right now and I'm drunk. Wait, what? We want to visit Israel. I'm paying the tickets. Hey man, be careful with being in the live chats when you're drunk. You know, sometimes you make bad decisions. 2,000? You got 2,000 shares of InMode? Really? That's a pretty hefty load, my man. I'm sure that'll pay out pretty nicely eventually. So anyway, as I was saying, this is just Smith & Wesson. This is just the one comparable analysis with one particular group. I took the same approach with many other companies here, so I kind of can share the basic summary of that. Here's Interfor, the forestry company that I have. Now, in this particular case, it ended up being the EV to gross margin ratio, as well as the EV to forward sales and the price to bookmate ratio that had the best statistical correlation for them. And the metrics that seemed to work the best for those particular multiples ended up being the forward revenue CAGR, operating margins, tax rates, return on invested capital, net margins, and return on equity. So as you can see, there's a lot of overlap there in terms of which metrics we ended up using, and a decent amount of overlap in terms of which multiples we ended up using, but still slightly different choices at the end of the day. So if we come over to take a look at the graphs, you can see that there's a negative relationship between the tax rates and the EV to gross margin ratio, which makes sense. It's what we would expect. We can see that Interfor appears to be a little bit overpriced in terms of that particular metric. And then there's a few companies that appear to be underpriced. The EV to forward sales and the operating margins, we expect a positive relationship there, and that's what we get. And we can see that Interfor appears to be about appropriately priced for that particular metric there. Then we have a positive relationship between net margins and price to book. That's what we would expect. Interfor appears to be a little bit underpriced in terms of that metric right here. Now, this is one of the reasons I was saying before. I'm probably going to switch out using the short interest as an axis here to scale against, because there's only a few companies that have short interest in this particular data set that I have right here, and so that's why we don't see very many companies, unfortunately, on this chart. So I'm probably going to change that going forward. But either way, just one thing you can look at here. Now, there's one other thing I kind of want to comment on when it comes to using this technique. As I was going to say before, is that this becomes a good tool for trying to maybe look for other ideas of companies to invest in terms of the fact that we're looking at a comparable group. You're looking at a group of other companies. And so you may have been focused on one company in particular when you made the group, as I was. Like, for example, this is a Smith & Wesson based group. This is an Interfor based group. And so all of these companies I chose as in relation to that particular company. But what you could do is you could say, hey, well, look at this other company over here that looks like it has good operating metrics that I like, and it appears to be significantly underpriced. Well, maybe I want to shift my attention to that one instead. So this might give you an idea of, well, what appears to maybe be a better choice of something to look at. Like, for example, on the FG one, or not FG, the Smith & Wesson one, the companies that appear to be the most significantly underpriced actually end up being the American Outdoors, as well as Big Five, as well as Claris Corporation. Now, each of them have slight differences compared to Smith & Wesson, and them being included in the comparable group I have reasons for including them. Those websites have the reason for including them, but at the same time, they're not necessarily the most comparable, but that's just one good example of one place where you might be saying, hey, well, if Smith & Wesson doesn't appear to be super underpriced, what could maybe be more underpriced? Is there a better opportunity there? If I come over to the Interfor group, where these companies are actually a lot more comparable, I'd say one company that you may have noticed noticed was under the line in all these cases. Canfor appears to be under the line here, just barely. It's significantly under the line here, a little bit under the line here. And then if you come over to the actual pricing metrics, it definitely is by and far the most underpriced out of all of the companies against the metrics here. And also, I mean, I've taken a look at a brief valuation of Canfor, and it's one of the ones that's on that back page of my valuation sheet, and I've just not got around to looking at it closely. So Canfor Forestry might be a decent opportunity, both in terms of valuation and pricing. I just haven't gotten around to looking at all of their production numbers or anything like that necessarily yet. So that's just one other example, Interfor. I could also show you, for example, Barrick Gold. I've done basically the same thing here. It's a group of 13 companies. I end up using the forward price to earnings ratio, an EV to sales ratio, and a price to book ratio. So still a lot of similarities, but still some differences. And then the metrics that end up being the most effective for the fundamentals, funnily enough, ends up being the same three metrics for all three of these, which is interesting. Gross margins, net margins, and debt as a percentage of market cap. So pretty interesting that those are the metrics we end up finding to be the most relevant. And if we come over to the charts here, well, actually, these charts are not correctly labeled. I just realized that I must have forgotten to change some of the stuff in here. So yeah, never mind the charts right now for that one. I guess I forgot to update some of the details on that one, but nonetheless, I can still kind of show you some of the details right here. Those are being the most effective metrics. I can come over, and it turns out Barrick is about appropriately priced, it looks like, in terms of comparing it to a comparable group. But companies that might be the most underpriced when comparing to a bunch of other precious metal miners, because that's basically what we're looking at here. We have Agnico Eagle Mining. Then we also have B2 Gold Corp. Then we also have Eldorado Gold. And then we also have IM Gold. So like all of those appear to be significantly underpriced, especially compared to Barrick. So if I was looking maybe for another different gold miner or silver miner, because that's a little bit of both in this category here, potentially looking at one of those might be a good direction to go for. In terms of something like that. I did also the same thing with FG right here. FG, the company we were just talking about in terms of where its valuation is going. That was one of the things that I kind of ended up doing this whole process for in the first place, is because I was rethinking my model for FG and its valuation. And I knew at some point I was going to come tell you guys, hey, I think maybe it's about fair valued if you weigh in a lot of the potential risks for FG, even though I still think there's a huge potential amount of upside. And so like one of the things that I was like, well, maybe what if I did a pricing analysis for the company as well? Maybe that would help give both me and the people who watch my channel a little bit more confidence in what I'm talking about in terms of why I still think FG has room to go. So I did a pricing analysis. Turns out FG appears to be about appropriately priced. But what you can compare it to? First of all, we're using a forward price to earnings ratio, an EV to sales, and a price to book ratio as our preferred multiples yet again. And the metrics that end up seeming to work the best for them is gross margins, operating margins, return on invested capital, net margins, and debt as a percentage of market cap. Those are the ones that work the best for those three metrics. And so you can come and take a look. FG appears to be a little bit underpriced in terms of debt to market cap, which has a negative relationship, is what we would expect. Net margins has a positive relationship, as we would expect. FG appears to be slightly overpriced in this particular case. Net margins, a positive relationship, as we would expect. And FG, there it is, a little bit overpriced in that particular category as well. So at the end of the day, it appears to be a little bit underpriced, but not significantly underpriced. And there's other companies that have significant, much more underpricing, which is one of the more interesting factors to keep in mind. So for example, Genworth Financials appears to be significantly underpriced by a long shot. So I'm kind of curious what's going on with that one. National Western appears to be significantly underpriced. And all of these companies are essentially just like other annuity companies or pension risk companies like FG essentially. So AFG, American Financial Group, that's another one right there. Not quite as much for that one, but significantly so. So if we're looking for more exposure in this space and think that FG is maybe kind of already run its basically the most that it's going to do in terms of excess returns, well, you could start looking at other companies within the space. So that's a pretty quick rundown of the relative valuation pricing dashboards that I've been putting together for different companies here, and how, like I said, it can be used in conjunction with the intrinsic valuation, the DCF templates that I put together to either A, feel more confident about the position you already have, or B, maybe look for other companies in the same space that potentially have other opportunities ahead of them. I'm bringing back around to the FG valuation because people still ask and wonder, okay, well, Derek, you keep upgrading your valuation. Now you've got it upgraded to about fair value. At what point would you maybe start trimming FG? The truth is like I said, I still think I'm significantly underweighing some of the opportunities, and I still think I'm overweighing some of the significant challenges that they have on the table for them as well. And so at the end of the day, I wouldn't sell it at fair value. I would only sell it if I saw it significantly overvalued. And that's part of the reason I like looking at these interquartile ranges. So you can probably assume that the interquartile range is maybe a good estimate of where I would consider selling it. So I would say currently, right now, I wouldn't sell FG shares unless it reached about $54 per share, $53, $54 per share. And at that point, I would maybe start trimming. I would be trimming. I wouldn't probably be selling out of the entire company, but I would be making significant considerations in terms of trimming. Because again, like I said, I think I'm considering in a 20% set of circumstances that I think are super unlikely but have potential for actually occurring, and then 20% of other independent margin outcomes as well that I think are super unlikely but could theoretically happen. So I think I'm heavily discounting some of the potentials for this company as a result of that. So now moving on from that, like I said, that's the comparable analysis page. I did also put together, as I was saying before, I was saying I had also put together some pages based more around mood and momentum. It's like that's pricing, that's relative valuation, and then there's mood and momentum, which, to be honest, mood and momentum kind of filters into how pricing works in the first place. So in a certain sense, they're not that different. But the point is I wanted to put together some dashboards to try to gauge some other factors that don't have to do with how the market is pricing things and don't have to do with how the valuation actually looks of why it is the market might be treating the stock a certain way in the short run to the midterm, and why some of those things might continue over time. So in particular, one thing, just kind of focusing specifically on momentum factors related to the price itself. I have a nice chart here of just the stock price over essentially like the last 2 years or so, and we got moving averages, the 20-day moving average, 50-day, 200-day. You can argue about which moving averages you want to pay attention to, but these are the ones that I'm choosing to pay attention to. And because like you can just pay attention to when it recovers over those moving averages or when they're crossing over each other. And then these black bars here are when they're reporting their earnings. I have those lined up here right here, so you can kind of get an idea of like what happens over the stock price after earnings or between earnings under certain circumstances. And then coming down, we also have relative valuation, so you can get an idea of when there is volume spikes in conjunction potentially with the earnings releases, telling you potentially when the better times to be buying and selling the stock actually are. And then I do have standard deviation ranges around that, though it looks like, as you can see here, the standard deviation hits 0 for below 1 standard deviation on that. Dr. Crisis, what's up? Get a chance to watch the Mark Green I sent over. I think that if you sent me a link to watch something, I think that might have gotten lost in the mix there. Maybe send it to me again. I'm not sure where you sent it to me. But Mike Green, yeah. But no, yeah. Maybe resend that to me if you sent something to me. I might have seen it and then forgot about it. But on Discord. What's your name on Discord? I know some people have different names, so that's one thing that often confuses it as well, is that sometimes it's difficult for me to forget things. Oh, you're Jax. Jesus, I see. That's the thing. It's like you often had been on YouTube, so yeah, I kind of forgot that was your name on Twitch. Okay, gotcha, fam. Yeah, okay. I saw the thing you sent me. I hadn't gotten a chance to look at it yet. But I was definitely planning on looking at that later today. Yeah, because you sent that to me just yesterday. Yeah, I get people's names on different platforms so easily confused. It kind of screws my brain up. But yeah, that looked kind of interesting. I hadn't gone to take a look at it, but I was going to do that at some point. Which, I mean, he's kind of bringing it up and reminding me. I will say at this point, if you're watching live or on the replay, it would be really appreciated if you guys would give the stream a like. Maybe consider sharing it if you would. Also subscribe to the channel if you're not already. Hit the notification bell and all that if you haven't already, and consider joining the free Discord. As we were just mentioning, the link is in the description below. It's also the pinned comment in the chat, but join the free Discord where you can send messages to me about random things that you find that you think could be relevant to share with me, or just be part of the daily discussions of what we've got going on in our own portfolios, in the market today, what the actions of major investors are doing, videos on things we thought were interesting related to learning about investing, stuff like that. So come be part of the community there today. Yeah. Yeah, I can't remember what the details of, but I remember when I was reading the description for the video you sent, I was like, "Ooh, that looks kind of interesting." I think I was hang out with some homies when I received it, so I didn't respond. But yeah, I'll probably watch that later. So anyway, getting back to the dashboard here. So as I was saying, we have uh, the earnings date, the earning dates with the black bars right here, and the relative volume as well. And then along with that, I also have the short interest going back for the last 2 years. We have the short interest is in the blue line right here as a percentage of the float. And then also the days to cover is on the red bars in the background. Now, I do technically have the average of both of those sequences right on top of each other, but they very often are basically right overlapping each other because of the fact that both of those are on separate columns right there. So effectively, they're just in sequence with each other. But it gets you an idea of where you can take a look at for at least in the most recent couple of weeks, or because it's usually a couple weeks to a month old in terms of the data. You can see, like, is the market currently shorting it more than it has over the last couple of years or not? And then the usefulness also of all these charts is that they're effectively all in a line with each other timeline wise. The short chart is a little bit different from these two, but for the most part, they're aligned with each other. So you can get an idea at this point in time what was happening with this metric over here versus this or that. And then that applies also as well to the daily RSI right here, which the bars for the RSI I have set to a +1 and -1 standard deviation. So it's not just set to 30 and 70 or whatever people often set. I like to use statistically driven guardrails as my metric. So 1 standard deviation is what we're looking at right here. And then I also included a weekly and monthly RSI as well. It looks like the standard deviation lines are not coming through for some reason on the weekly one right here for some reason. So all those are a little bit more technical driven and share statistic driven details, and a little bit less about the company itself. But then I do also have a variety of metrics further down as well, a little bit more narrowed in on the company and how it's operating. And particularly some of the investors and how they're thinking about things. So we have, for example, the insiders transactions here. We can see how it's been changing on a quarterly basis for the last 5 quarters, and the insiders as a percentage of the float as well as listed right here. So in general, for example, with Smith & Wesson, they were selling a little bit, selling, no selling for a quarter or two, and then back to a little bit of selling. But overall, the overall levels of the insiders haven't really shifted that much in terms of percentage of the total float. And then analyst ratings, you can get an idea of like what the distribution is of buys versus sells and holds. You can see it's about 2/3 buys, 1/3 holds, no sells. And then the number of estimates you can see has been consistent over that same period of time. And then the analyst estimates, you can take a look at the average analyst estimate is where the green area is, but then also shows the high estimate and the low estimate. So you can get a little bit of the distribution of the analyst estimates, see how they shifted over time. So like with Smith & Wesson, you can see that the analyst estimates came down a little bit and they stayed flat for a little while, and then they've started to move up, or well, they didn't really move up. As you can see, the high hasn't shifted, but the person who had a lower estimate actually brought their estimate back up towards where the median point is, and so that effectively brought them average up slightly over time. And then it also the black line shows where the current stock price is as a ratio of the estimate. So or I had that reversed, the estimate as a ratio of the current stock price. So you can see in general it's been undervalued according to analyst estimates, undervalued according to analyst estimates, fair value according to analyst estimates, and then undervalued according to analyst estimates. So you can kind of just get an idea of like how has the analysts sentiment around the stock been shifting over time? How has the insider sentiment been shifting over time? Also, the EPS estimates, it shows how they moved over time from anywhere from 90 days ago, 75 days ago, 60 days ago, up through 14 days ago, and then the current estimate. And then we have that both for the next quarter and then the next year quarter. So you can get an idea of like, are the analysts dropping their estimates and lowering their targets, and stuff like that. You can kind of like think about these things in conjunction with each other. Are the estimates next year starting to look better? And is that maybe the reason why the analysts are starting to get more bullish? You can kind of think between the lines a little bit by comparing a few of these charts together with each other. And then I also have this earnings surprise chart right here, which I really like this one, but unfortunately, the data source where I was getting it from decided to change their website around literally a couple days after I started playing with this. So unfortunately, I'll have to find somewhere else to get this information, or maybe remove it or something like that. But basically, it showed the way the metrics had changed over the had been in relation to the estimates, whether they had been surprises or not, on revenue, EBITDA, EBIT, net income, adjusted EPS on the day of the release, and then also the 1 day stock movement we have with the line right here. So you can see like there was a huge negative surprises, a huge negative stock reaction, positive surprises, growing stock reaction, and then negative surprises, negative reaction again. But like I said, unfortunately, I'll have to find a new data source for this particular one, which kind of sucks because I thought this one was pretty useful information. Getting to your questions, Jax, in terms of dynamic, I assume you mean do they automatically update? Unfortunately for these ones, no, they don't. These ones require copy pasting. But most of these things don't update but once every couple weeks to a month anyway. So it's the kind of thing that, you can kind of take your time with, and it's really more like a snapshot in time of when you're trying to look at things. But for all of the SMAs, the relative valuations, and the RSIs, those I'm calculating in the spreadsheet myself. So these ones automatically do update. But yeah, it does suck that unfortunately these don't automatically update. Maybe at some point I'll find a way to get them to, but that definitely is a little bit more of a pain in the neck. It's definitely not something that unfortunately I can just keep a database of companies with these sheets for. It's really more of like when I'm specifically looking at a company, I have to decide to take the time to fill out one of these sheets real quick, which by the way, doesn't take that long. It honestly takes like 5 minutes to copy paste this information from a few different websites into place. Maybe 10 minutes if I want to double check some of the formats on these things and make sure it's all looking nice, right? So at 10 minutes at most to get a good looking snapshot at a lot of this information. And unfortunately it won't, like I said, at least this, the bottom half of it won't automatically update. So it's only going to be relevant while you're thinking about that next week or two probably, or something like that. But it's maybe something you can do, like if you're gearing up for a new earnings to come out. Like, you can see like when the earnings are likely to come. If you think if earnings is going to be coming out in the next 2 weeks or something, maybe filling out one of these bad boys so that you have maybe an idea of how you think the market would react under certain circumstances or something like that. That's just kind of like one way you could think about using this tool. Like I said, it's like I've built this tool kind of in conjunction with the relative valuation tools that I wanted to also basically be in conjunction with the valuation tools. So I'm kind of trying to just put together a few different things so that I'm not just relying on just the DCF number. I'm trying to gauge how is the market pricing comparable companies, and then how is the mood and the sentiment surrounding the company and in the analyst behavior, in the investor behavior, and stuff like that. So yeah, pretty happy with it, but yeah, it definitely has its limitations. Here's the same page for Interfor, for example. Basically kind of same thing, but you can see it's a little bit different. Here, the relative volume does actually have the -1 standard deviation above 0, which is nice. Much lower levels of short interest under this particular circumstance. Looks like the weekly RSI is working on this one. I'm not entirely sure what's driving the difference there. But pretty interesting. Not too long ago, it was getting pretty significantly oversold on daily, weekly, and monthly. That would have been a pretty good point to buy in. I definitely thought the Interfor was a good buy over the last couple months. I just unfortunately had my allocation already filled out, so I couldn't. I didn't really want to continue allocating more to it. I just wish that I had waited to buy into it. But either way, pretty interesting. And then similarly with Barrick. Filled out another one for Barrick as well, and then another one for FG. And you can see like FG has only existed for about a year, so that one has a little bit of a shorter charts for some of these metrics, and it doesn't even have the weekly and monthly RSI coming in here correctly at all. But yeah, So yeah, these are definitely somewhat of a work in progress. Still kind of hoping to tweak some of the issues with a few of these things. And as I said, I need to find a new data source for some of the details there. But pretty pleased with how a lot of that stuff is coming out. Also been in conjunction with all of that, I did kind of have to put together a new financials spreadsheet in the first place, and to kind of work with the new valuation stuff. As I was kind of showing the valuation template, I was trying to work out some of the kinks that makes it difficult for me to update it every single quarter, which has to do partially with the trailing 12 months feature on it. So I fixed a lot of the details with that, which required me to fix a bunch of details in the financial spreadsheet, which one of the things that I thought was not as good about my financial spreadsheets is that I ended up having a few extra features that ended up being kind of redundant in it. So I kind of needed to remove a few extra redundancies in it, as well as initially I had the pricing stuff related to like stock momentum and like the actual stock price charts and stuff like that. A lot of that stuff was inside that financial spreadsheet to begin with. So I kind of needed to separate the two into a separate page as well. So what was originally one financials page and one DCF template is now a financials page, a DCF page, a relative pricing page, as well as a mood and momentum page. So I've sort of got like 4 pages for each company now whenever I do an analysis. 4 different files, I should say, because each one has multiple sheets within it, but still, whatever. But the point is, the process has become a little bit more complicated, but hopefully a little bit more fleshed out at the same time. That's kind of the idea there. But one of the other things I did want to adjust was a lot of the charts. For example, I thought that the charts that I had put in my previous financials page were some of them were good, but other ones were a little bit more complicated, redundant, and other ones just not necessary or poorly put together in a way to kind of like show things. So I think I've made the current ones a little bit simpler and neater in what they're trying to portray, which is very, very helpful. And at the end of the day, the goal is to try to make it so that I can more easily take snapshots of my information and share it with people at the end of the day too. So one other feature you can do with the Google Files programs is like their PowerPoint program, or their slides program, I think it's called, actually does have some pretty neat features for importing information from their other programs. So like, for example, charts and stuff, if you can neatly depict something in a chart, you can actually have it import directly into a slides program pretty easily, which means at some point, like, I don't necessarily have to share all of my spreadsheets. I could theoretically just share a slides document format that essentially just has different pages within it with all of the different charts. So it shows essentially all of the historic information that one might get from these particular charts right here. But then it could also then at that point also include all of the charts off of the DCF page, but then also all of the charts from the other stuff as well, including like the comparables analysis and some of the mood momentum stuff as well. And so at some point I could just have like one file that you could open that has all these charts coming from multiple different locations. And that would be, I think, a little bit of an easier way to try to share all this stuff with other people at the end of the day, which has always been an eventual goal that I constantly am running into roadblocks in terms of how to go about that. So either way, pretty pleased with this. Still a few things to tweak with it, but that's pretty much what I've been working on for the last week or two. It's been a whole bunch of stuff that I've been working on, because I put together the Apple valuation and I followed that up with the Skyworks valuation, but now I'm kind of sitting on my hands, not 100% sure which company I wanted to do next, but I kind of wanted to try to crack out all of these changes and all of these updates and stuff before I started working on another company, because at the end of the day, I hate having kind of like multiple file types for something. I like to do a full update on a file type and then basically convert everything over to the new file type and then move on from there. I kind of hate having things in multiple baskets, so kind of was holding off on that. But the point is as I kind of already hinted at, when it comes to doing the comparable analysis for the different companies, that ends up opening up potential doors of where to maybe look for companies, because of the fact that you sometimes discover there are other companies that are underpriced in your little comparable group that might be worth looking at. So like maybe Claris Corporation is one that I might take a look at, or maybe Canfor Forestry is a company that I need to double down my looking at. Or as I was saying before, maybe B2 Gold would be another potential way to get good exposure to that commodity that would be worth looking at. So I do plan to take a look at basically all of those at some point in the near future. And there are plenty of other bigger companies as well, some larger companies that I'm just feel less interested in for one reason or another. For example, a lot of people have suggested over the last week or two that maybe I should take a look at Starbucks. That maybe that would be another company that's worth taking a look at. That's down at a potentially good valuation, and I'm not super bullish on them as just kind of a company in general. There's lots of things to be bullish about them in, but there's lots of question marks associated with them that I'm not a huge fan of either. And so it's one of the ones where I've just kind of been holding off on it because I just don't feel like it's necessarily super for me. But if I build a comparable group for them, maybe I'll find something else in that space that's even more interesting to look at. Another example would be John Deere and Caterpillar are companies that people ask me to take a look at. And I actually am somewhat interested in that industry, in that space a little bit, but I really don't think those particular companies are necessarily super likely to be a huge bargain. But maybe if I do a good comparable page for farm and farm equipment based companies, then maybe I could actually find out which one would be better out of the entire grouping. So that's probably things I'm going to be doing over the next week or two, is basically trying to put together interesting comparable groups to then do pricing analysis on, to maybe find the best underpriced company to maybe do valuations for in general. John Deere is incredible to me. Where's their competition? Yeah, well, I mean, that's one of the reasons, like I said, I like them as a company. I'm just not necessarily convinced their stock is is the greatest of things. But they're an incredible brand that are super great. And they might be a decent one. We like me and Scott, the well invested in the Discord, we were looking at John Deere a whole lot. So like I've been looking at their multiples and stuff, and they definitely seem like they're not super expensive. I just don't think they're necessarily screaming cheap either on anything other than a relative valuation compared to themselves. But we'll see. Maybe they look also cheap compared to their competitors, and then maybe the valuation is worth doing. So who knows? Like I said, maybe I'll be looking at farming equipment at some point in the near future. It's been on the mind. It's been on the mind. But I have been trying to maybe, as I was kind of hinting at, turn my attention back over to forestry and gold mining a little bit as well. That's definitely been things that I've been thinking about as other things to maybe look at. So we'll see. We'll see where things end up in terms of that. Still definitely trying to figure out what company I want to look at next, but lots of ideas on the horizon. So let's see. I think that was that pretty much everything I was looking to talk about today. Am I forgetting something? Oh yeah, Costco. We were just talking about that actually in chat. I had totally mentioned that you had suggested that to me as a short potential. I was like really glad I didn't take that too seriously. I mean, look, it's one of these things where it's like it's difficult to determine when something is going to eventually lose steam unless you have like some big event driven reason for it. Costco might continue to just be incredibly expensive for a long time. But I'm sure if I did a comparable analysis on them, as you were kind of pointing out when we were chatting about it the other day, it's like they're very pricey compared to any comparable company, and they're almost undoubtedly equally as overvalued when it comes to an actual intrinsic DCF. But it's like, man, that'd be intense. When you say short something, it's in the context that maybe you only have about 10% of your portfolio in short in aggregate, and that maybe that would be a tenth of that allocation. No, I mean, fair. I wasn't even making any comments about proper allocation when it comes to short selling. I think that definitely is a pretty appropriate way to maybe balance the risks of short selling. It's like, yeah, maybe only short with no more than maybe 10% of your portfolio, and then maybe, yeah, try to have it reasonably diversified amongst that as well. If I was to short something, an individual, I probably wouldn't be shorting more than, yeah, like 1% of my portfolio or something like that, which is effectively what you implied there. So yeah, I feel that. And I mean, like I said, like I'm just not a big fan of shorting in general, strictly on valuation and pricing alone. In my opinion, there has to be some sort of catalyst in there at the end of the day. There has to be earnings that we actually have some solid reason to believe are going to be really bad, or some corporate event that we're waiting on the news of that we think is going to be kind of bad. There has to be something that's going to drive the difference between the value and price and the current level back together, in my opinion. Fraud, if you believe there actually is fraud, and you believe that like that fraud is eventually going to become aware of to the public and something like that, it's like those are the things that I think you want to only short under. Like, for example, I technically allow for shorting within my strategies, but all the shorting I do is related to an index, right? So like I'm either shorting the S&P 500 or I'm buying puts on the S&P 500, which is effectively shorting, right? And so like in both of those strategies, my catalyst is economically driven, right? The catalysts that I'm relying on are macro driven, which at the end of the day are still kind of weak in terms of catalysts because they're relying on assumptions that may or may not be true. But the point is I allow for that because that's at least still sort of an index driven thing. So it's more because of the fact it's an index, it's more directly tied to the macro thing. But for an individual company, I have to think about like what on an individual company level is going to drive those things back together. So that's one of the things I'm just super hesitant to do any sort of shorting of individual companies for. I've never shorted an individual company. I've never once done that. But I'm not opposed to doing it. I just have to have the right catalyst to, in my opinion, drive the thesis. And I've never been in a circumstance where I had something that I thought was super overvalued and I thought I had a good catalyst for it at the same time. So maybe someday. While speaking of this, he said, I would love to talk about something that Mike Green talked about in that video on high valuations that was a perspective shifting for me. Yeah, well, I mean, if you can throw some of the details at me right now, go for it. Like I said, I'll probably watch it later, but here we are pretty much coming to a close with the live stream, so I'm definitely down to talk about whatever if you want to throw those details at me. One second. Pull. You go see where that link is.
Attention retirees.
Give me no.
To be at your computer from 9 a.m. to 10:45.
How? I just want to know how long this is. Okay, it's an hour long. Yeah. Yeah, I'll probably have to just watch that later. He blames high valuations specifically on mega caps on passive investing. These investors have no calculus and they just buy the market at whatever price, truly inelastic. Yeah, because like I read some of some of the headline just kind of words is like the dangers of the rise of passive investing, and I've heard people kind of talk about this concept a bit. Michael Burry was kind of going on about the ETF problem a little bit a year or two ago, and people kind of poo-pooed a lot of his concerns on it. It's one of the things that, yeah, because people often say it's like, oh, well, with the rise of all the ETFs and stuff, doesn't that make like active investing kind of a waste of time? But it's at the end of the day, yeah, no, I think it's sort of the opposite because there's essentially less appropriate price discovery happening because of the fact that people have just shifted largely to passive investments. So yeah, like I'm not 100% sure of the details he talks about, but I probably largely agree with his thesis. Truly inelastic. When these passive investments buy into the market every week, they buy blind and buy heavy on big cap companies, but these companies don't have enough stocks to even sell to these passive investors. Prices rise, and the passive investors don't care at all about the valuation. Yeah, no, yeah. I mean, like I said, I've heard a few people kind of talk different directions around the same concept. But I mean, I largely agree. It's one of the things like I personally think that this is actually a great time to be an active investor. You just have to actually be very, very long-term minded. For example, like, I don't know, let's just hop over to the rut, see like how long the Russell likes to, for example, take these big long waits, right? Like it legs up, the Russell legs up and then it waits a few years. It legs up and it waits a few years. And that's like the real dumpster diving, right? Like that's what you have to wait through versus the S&P 500 over the same period is just kind of goes up and up and up and up and up for the most part. So yeah, it's like I definitely agree. It's one of those things where the lower end of the market, it just doesn't have capital constantly flowing towards it in the way that the other parts of the market do. But I do think some of those dynamics do shift back and forth over time. So like one of the theses things around the FG evaluation is, for example, the idea that equity markets are going to start taking hits as boomers begin to liquidate their portfolios more and more over the course of their retirement. So it's definitely one of these things where I don't think those factors necessarily last forever, and I do think they eventually will start to come back around. It's like it's not a type of thing where oh, this time is different and we've reached a new paradigm. At the end of the day, valuations will matter eventually. It's just for a very, very long time, people can ignore them because there's literally just so much money out there and the money has to go somewhere because that pension fund or whatever has to make its 5% or something like that. He also argues there's no reason that the gravy train should end because the practice begets itself. More and more money goes to passive investing because it's more successful, which makes passive investing more successful because the only thing that passive investing needs is more inflow. Yeah, which I generally sort of agree. I don't agree that it lasts forever, though. That's the one thing that I sort of disagree with. It's like it begets itself until it doesn't. There's always reset points. The reset points may in fact only last short periods of time though before another cycle begins of doing the same process. So, but I do think that there are eventually going to be reset points in that process there. A great quote from the video: nowadays, 98% of active investors underperform the market. In any other test, if 98% of people failed, we'd say it's a broken test. How is it not a broken market if 98% of active investing is worse than passive investing? Active investing is dying to passive investing. Yeah, well, I mean, it's the thing is like I don't really agree with the conclusions. I agree with the observations. It's like active investing isn't dying, it's being squeezed by passive investing. But I think that that's something that happens in a cycle. I think that people get squeezed out of active investing, and the very act of them leaving the active investing market creates inefficiencies more and more and more and more. And then those inefficiencies create circumstances that are beneficial to the active investor. See, like for example, all the money pushing up with the mega caps, you might say, well, how is that going to work? How if the small companies never get any capital? And it's like, well, there are other ways to profit, like dividends being paid out and companies being bought out, for example, right? So like maybe all of the activity essentially shifts towards more shareholder friendly forms of governance, like companies that are essentially going to pay out the dividends. So like for example, if a stock never gets bid up, then eventually its dividend yield is going to reach 100%, right? Like that's what's going to happen if the stock literally never gets new capital and it never gets bid up because bigger companies are receiving all of the price capital. Well, then eventually the dividend yield is just going to be rising and rising and rising. So eventually it creates free money situations, arbitrage, right? Which can't really exist. So at the end of the day, these things balance themselves out over time. It's just we reach a period where effectively people have to be dragged up, or I should say the smaller companies have to be dragged up by the fact that they're so cheap that it creates such a rich profit opportunity that people will eventually jump into it. And if the profit opportunities become good enough, even some of the larger capital pools will be more and more capable and willing to jump on it too. So it's like I don't think active investing can die. I think it's not really possible for it to die because if active investing dies, I think all of investing effectively starts to die, and then that creates those opportunities. It's really like a cyclical thing, but the cycle is long. We're talking about a secular length cycle, so something that probably can keep going in one direction for like 30 or 40 years at a time before it starts to spin and turn back around. Because people were technically saying similar things back in the 60s as well. And then we went through a period of active investing being king for 2 decades after that, and then it shifted back towards passive investing as well. The only difference was that passive investing was itself very, very inefficient during the previous cycle because technological stuff hadn't really moved to keep up. Now at this point, we do have the technology for active investing to essentially push that kind of begetting itself part of the process. But I still don't think it can last forever. It's like it just creates the opportunity for active investment in itself. But anyway, so I think that's probably going to do it for today. Interesting topic. I definitely think I will check out that video. Now that you brought it to my attention. Like I said, was busy, I think, when you sent it to me before. I'll be taking a look out, trying to figure out what maybe to build a video for or what to invest in next. Other comments I would maybe comment on is I had been watching Baytex, which is a company I made a video for earlier in the year. It got very, very overvalued at one point, and then what with the oil declines, it's come back down much closer to fair value. I've been keeping an eye on it, but I would still definitely like a margin of safety before starting a position in that one. But the other energy company, which I didn't make a video on, but I did make a full model for and put it in the spreadsheet here, is a little bit more of a fair value, but this one is also much more focused on Colombia. So this one was a little bit of a different story there. But either way, multiple oil stories potentially becoming more of an interest. And that's at the same time, the oil prices themselves would come back down closer to where I was saying I thought on a fundamental basis, oil ought to be in the first place, which was about $69 a barrel. So we're only a little bit above that right now, which means that, in my opinion, potentially it's not too dangerous to be looking at oil plays if they themselves are undervalued. That would be better if oil was underpriced and the companies themselves were undervalued, and if maybe they were underpriced as well. I'll maybe be doing some oil company pricing comparison sheets as well along with that. But other companies, like I said, some of those other companies in the comparable groups, the Interfor or the forestry companies, the gold companies, I'll be looking at some of those agricultural companies and other stuff like that. Maybe another one of those annuity companies. I wasn't necessarily trying to get too much more exposure to that, but maybe I'll start to take a look at it. But if you have other suggestions for companies that you would like to see me maybe take a look at, consider leaving them in the comments below after the video. Please remember to like the stream if you haven't already, whether you're watching live or on the replay. Also consider joining the free Discord. The link is in the description below, as we had mentioned a little bit earlier, and other stuff like that. So I'll catch you all in my next live stream or my next evaluation video. Maybe we'll try out Friday again next week. I don't know. We'll see about that. All right. I'll catch you all in the next one. Bye.